Hi guys, good evening and welcome to Editor's Roundtable. It was a week of turmoil in the financial space. The Sensex and the Nifty end down with a cut of 2%. Will we see a recovery next week? Thank you for joining in to Editor's Roundtable. I am Reema Tendulkar. Joining me is Prashant, Nimesh and Mangalam. Hi guys, I think we can all heave a sigh of relief. Right?
That the week is over.
That the week is over.
The news flow
But
never...
the weekend is ahead of us. And if last weekend is any indication, this one could be action-packed as well. Although, I mean, we don't report on it at least, right? Yeah. Not on Saturday or Sunday.
But these guys have some exciting plans.
Cricket, I believe.
Cricket.
I watch the match there. So after this show, I just want to rush to the match.
Yeah, same here. I'll hitch a ride with you. Because there's no parking outside.
And I was lucky to watch the
You're going to sleep on your couch.
Yeah, absolutely, Reema. But what a week we've had, right?
Eventful.
Eventful and I would say historic, right? Actually, let me just go across to the big wall and tell our viewers what the week was all about, because this is, you don't see weeks like this very often, and we did see one. At the start of the week, this was being compared to Lehman, Bear Stearns, 2007, 2008. Thankfully, it turned out to be nothing like any of those episodes. But I have to say that history was written tick for tick. Let me tell you why. And the story starts last Wednesday. That is when the Silvergate Bank announced that it is shutting down. I mean, actually, that announcement came after US markets shut on 8th of March, which is last Wednesday. Let's move on. The story moves forward. I mean, the turmoil started. The market started to worry a little bit, but not full-blown. And then you had the Silicon Valley Bank, which failed. It went into FIDC receivership. That was Friday. Things started to accelerate post that. Move on to the weekend. That is last Sunday. You had the failure of Signature Bank, which went down. These are regional banks as we've been discussing quite a bit. Markets were panicky. We woke up the next morning, Monday morning here, with news, good news, that the US has stepped in to protect depositors. Also, as a consequence of this, all of this financial turmoil which was emerging and uncertainty which was there, Fed hikes were priced out of the system. They completely vanished. From 50 basis points 4 days earlier, we started the week with 0 rate hike expectations. Tuesday, we got core CPI numbers which came in, which were stronger than what was expected. Some of the Fed rate hike expectations were priced back in. Wednesday, the worry was passed on from US to Europe. Credit Suisse was suddenly the epicenter of all the panic. European markets started selling off in a big way. Thursday, you had Credit Suisse, which took $50 billion from the Swiss National Bank, and the ECB, later that evening, hiked interest rates by 50 basis points as well. And this morning, we woke up with news, that is Friday, that the US bank consortium has put in $30 billion in deposits into FRC. This is a timeline, a tick-by-tick timeline in terms of what has happened over the last 1 week or so, a little over the last 1 week. But these are just the highlights, right? I mean, we lived through what went on, the ups and downs, and boy, it was up and down many times over. Now, how has the crisis affected markets? This is interesting. Again, this is price change since the 8th of March close, last Wednesday close. And it's stunning. The S&P is down under 1% for all the troubles, under 1% lower. The Nasdaq is up 1%. The Nifty is down 4.2% with all the distance. The Nifty is the one which actually is taken under the chin. The US 2-year yield is down 92 basis points. It was above 5% a week before, a week and a half back. It's now a little over 4%. The dollar index is down 1%, and oil prices have sold off very aggressively by about 10% or so. Now, I just kind of dug in a little bit more in terms of Nifty is down 4.5%, right? And US is up. But how does Nifty compare to other Asian emerging markets? Guess what? Nifty and Sensex are the worst performing emerging markets in this current risk-off episode. So, I mean, actually the only market, forget sort of emerging or developed, the only Asian markets which has done poorly as compared to Nifty is Japan. That's it. Otherwise, we are the worst off. And, perhaps some of the reason is the FII selling, right? But there have been so many blocks, so to kind of cancel the noise out, what I did is basically take total DII and FII inflow into the market year to date and subtracted the total amount of blocks which have happened. So the total institutional inflow into secondary markets this year stands at 7,200 crores. That's paltry. That's very, very small. Valuations have come off quite a bit. The Nifty one-year forward PE now, as of the end of Friday's trade, stands at 17.3 times. The average for the last 15 years is 17 times. But when you look at PE multiples, the discount rate matters quite a bit, and that goes back to talking about interest rates. Direction of interest rates are extremely important, and that will determine, what happens to interest rates and hence valuations, etc. And to that, in that context, we've got the FOMC, which will be meeting next week. So just thought, I'll put some of this stuff out. With the amount of volatility we've had, I have to say that markets are a little volatile. Markets are a little jittery and shaky as well. And I think it'll take some time before some normalcy, some stability kind of returns. Nimish, you've been talking to a lot of dealing rooms as well. What are you hearing?
Prashant, you put out some interesting data. The fact that Nifty was down 4% this week despite global markets, well, there was too much of noise, but they were stable. And that means that, a lot of crucial technical support levels got broken on the Nifty, and that actually led to a lot of fear as well. So the mood is very downbeat. There is extreme pessimism, so to speak, when you talk to the dealers or the larger investors, or for that matter traders as well. So the level to watch now is 16,800 on the downside. If you look at this week, twice we came to those levels and we rebound from there. So that's a big support level to watch as far as the Nifty is concerned. It is in the very near term, so that's something to watch out for. Last week, if you remember, I had suggested that the block deals will continue, and we're going to hit $5 billion before the month of March. And in fact, it happened this week itself, right? Another $1 billion block deals happened, and we've touched over $5 billion as far as the supply is concerned. So that supply, my sense is likely to continue. But the big feedback now is that while everybody is watching about block deals, my sense is there could be large M&A transaction as well. That's the feedback from investment bankers, that watch out for some large deals which might happen before the end of this financial closure. So that will be important to track, and that can have an impact on some stocks as well. I guess from a trigger point of view, the Fed meet next week. That's going to be very important. I guess Street is priced in the 25 basis point rate hike. So if that comes, I guess there will be a bit of a relief rally, so to speak. That's the overall feedback from the dealing room. So that's something to watch out for. The other important thing is, if you look at the mood, at least in the last 2 days, the feedback was some bit of risk appetite is back, largely from the smart HN investors. So around 16,800, 16,900, some money was put to work by some large smart HNIs, and the feedback is they are sensing a bit of a pullback post the Fed meet. So that's something to watch out for. But I guess the supply overhang is something that's a big niggling factor, and that's likely to continue till the March end. That's the overall feedback. But I think most important thing is the banks. That's been a big underperformer, and I think you've worked on some number on the banks as well.
Well, absolutely. This week was all about the banks as people were assessing the health of the global banks in US and Europe. So the big question now, is there a risk for the Indian banks, right? How do they hold up in light of what we are seeing right now? So first, let's take stock of how the banks performed. This week, the Nifty Bank was down 2.2%. The PSU banking index slipped 4.5%, and individual names, a Bank of Baroda, a State Bank of India, all took a deep tumble. So we're taking a hard look at the health of the Indian banks, and we're evaluating them on 3 key parameters. The first one is the quality of the liabilities, that is your depositors. Secondly, the yield impact on the investment book. Is there a risk of big losses, the M2M losses on the Indian bank's portfolio, on their bond portfolio, due to the rise in the interest rates? And third, the risk to the asset quality. So the first one, let's talk about the bond portfolio of the Indian banks. Now, CLSA says the Indian 10-year bond yields were at 7.5% pre-COVID, early 2019. They dropped to sub 6% during COVID, but now they've rebounded to 7.4%. CLSA's discussions with a few PSU banks suggest that the break-even for an M2M loss for PSU banks is roughly 7.5%. So even if yields go up by another 500 basis points, according to CLSA, the PBT hit is likely to be manageable and at approximately 5 to 7%. So this is on the bond portfolio. Now let's talk about the liabilities. Depositors. Is there a risk of a big outflow of depositors? Something that we've seen in the United States and few of the banks like SVB. Now Jeffrey says that in India, household depositors constitute more than 60% of the depositors. Now, these are sticky. They don't typically move to GSEC. So the concentration risk in India is very low, and therefore the risk on this front is on the lower side. And the third parameter to look at is the asset quality. Now here, what we've picked up is the mortgage rates in India pre-COVID were 8.5%. They fell to 6.5% during COVID, but now they're at levels of 9%. So the increase of EMI rates in India is not as severe as what we've seen in the Western economies. And therefore, the likely hit to asset quality is again likely to be on the lower side. And plus, the bank's asset quality, the kind of buffers, the contingent provisions that they are sitting on is the best that we've seen in over a decade. Banks themselves are not very worried. This week, Morgan Stanley put out a note in the Indian banking system. They met with a lot of financial institutions, and their key takeaways are that banks are saying that the loan growth is likely to remain healthy. Yes, there will be some NIM moderation next year as funding costs catch up, but the asset quality remains benign. So banks are not worried. Are the brokerages worried then? So here's a quick roundup of the brokerage commentary. Jefferies, in its note this week, says the SVB test on the Indian banking sector holds up again. CLSA says negligible contagion risk, no material impact except for heightened risk premiums. And Macquarie says it's Goldilocks with a minor bump. So that's just a quick summary of what is the health of the Indian banks based on what's happened globally. We need to slip into a very short break at this point, but on the other side, we'll talk about the top management changes that have taken place this week, the announcements on that front, and we'll also invite Hiren Ved of Alchemy.
Welcome back. You're watching us here on the Editors Roundtable on CNBC-TV18. If there's one thing that the last couple of weeks have taught us, it is that change is the only constant. And there were a lot of management changes that took place across multiple sectors. So, in case you heard those numbers and names on a stray basis, I've compiled all of them. We start with the IT sector, and the biggest one that happened on Friday itself, the unexpected resignation of the TCS MD and CEO Rajesh Gopinathan, and then his successor K. Krithivasan being appointed as a CEO designate. Of course, he's an old hand at TCS itself, 34 years in the company, heading the BFSI vertical. But that's not the only big change. We had TechM finally announce the successor to CP Gurnani as well. Mohit Joshi quit Infosys to join Tech Mahindra as CEO. Of course, this after CP Gurnani's term ends in December itself of this year. But what it also revealed was Infosys is now turning out to be a bit of a leadership factory, because earlier itself we had Ravi Kumar quit Infosys to join Cognizant as its CEO too in October 2022. But let's move away from IT to insurance. The big mover in trade during the week was ICICI Pru. Thereafter, this was after Anup Bagchi was appointed as the MD and CEO of the company for 5 years. Of course, he succeeds NS Kannan, whose term superannuates in June itself. What's interesting is both Bagchi and NS Kannan are ex-ICICI EDs, so big bankers going into the insurance vertical. Talking about big bankers, well, the biggest insurance company made 3 announcements. M.R. Kumar retired and Siddharth Monty has been appointed as the interim chairperson of LIC. But apart from that, they also announced appointments of 2 managing directors, M. Jagannath as well as Tablesh Pandey, who has replaced BC Patnaik. Now, in case you're wondering why is there 1 chairman and 2 managing directors, LIC has the capacity to have 4 managing directors and 1 chairman as per the LIC Act of India. But moving away from insurance into the financial institutions, banks, Sumant Karpalia's term as MD and CEO was extended for IndusInd Bank. Of course, the board had asked for a 3-year extension, but the RBI had granted just 2 years of extension, as a result of which there was a bit of a dip on the stock price. But then again, let's see where that goes. There was a CFO change at Karnataka Bank as well, where Abhishek Bagchi, who was earlier at NSDL Payments, has joined as the CFO. And the biggest one coming in from HUL, the FMCG sector, it was, finally clear that Rohit Java will be leading the company, and this after Sanjeev Mehta hangs his boots after being at the helm of the consumer major for 10 years in a row. And that also proves HUL's leadership factory once again, because we had Prabha Narasimhan join Colgate from HUL way back in April 2022, and a year before that, Sudhir Sitapati joined Godrej Consumer from HUL as well. But appointments weren't the only ones. We had a couple of resignations too. Bittu Varghese, who was important in the IPO process of Sula Vineyards, has resigned as the CFO, and Mahindra Lifespaces, the MD and CEO, resigned, and we had Amit Kumar Sinha as the MD and CEO of Mahindra Lifespaces. All of this happening in just the last 10 odd days. So these were all the big changes. We also welcome Hiren Ved of Alchemy on our show. Hiren, thank you so much for joining in. These many changes, of course, all these companies are well-oiled machines. Just wanted to know if there is one change that stood out for you and you are betting on the company or looking at differently after a management change?
Well, I think, in the case of TCS and HUL, I think it should be business as usual, right? I mean, these companies have a very, very strong bench of managerial talent. These are large companies, well-oiled machines, and therefore there should be no disruption and there should be a reasonable amount of continuation, right? I think usually what is exciting is that if a company, for whatever reason, has not been doing so great within the sector, and you do get a new leadership, I think that there is, there is a point to be considered that things could significantly change in terms of strategy, in terms of performance, and so on and so forth. So if you put that perspective, then I think the two most notable ones that I would suggest is, one is iProve, where Anup Bagchi has taken over as the CEO. He has had a superb track record in ICICI Bank, and I do believe that that he will certainly be able to make significant changes in the trajectory of growth for iProve. Obviously, the entire insurance industry is entering some kind of a regulatory headwind with the cap on the tax benefits for large policies. But given his retail experience, I think that there is a reasonable probability that he should be able to bring iProve into top gear. And the second name would be Tech Mahindra, where I think that they have great capabilities, but both from a margin and growth perspective, I think that there is a clear possibility that things could change for the better. And I think the markets recognize that pretty quickly when these two changes were made. The stocks rallied. And usually our experience has been that, there is usually a honeymoon for a year because investors give them a benefit of doubt. There is a hope, there is a certain option value that is built. And then they obviously would want to see the change in performance. So typically they do give a thumbs up. They give them a couple of quarters, and then it really boils down to what changes these new CEOs and leaders make in the respective organization. So from my perspective, I think these two are the most critical.
Got that. The other important thing is, Hiren, the bank Nifty, that's been a big underperformer. While as Rima also pointed out, it's a Goldilocks scenario for most of the banks. But bank Nifty is down 10%, individual stocks are down 15-20%, and we had a change in IndusInd Bank as well. So view on IndusInd Bank after the change, and overall on the banking sector, what's the pecking order there?
So I think with IndusInd Bank, in a way, it's good that there has been a 2-year extension. Well, I think initially people they had applied for a 3-year extension, but they got 2 years. But 2 years shouldn't be bad, right? I mean, 2 years is also a reasonable time frame. I think the sell-off in the banks is largely to do with the risk off we've seen in the last couple of weeks, because, and especially after the SVB bank failure in the US, while I think that there is no direct correlation, I think Indian banks are pretty strong, great deposit franchises, very well capitalized. and so on and so forth. But I think it was more of a risk off, which is being reflected in the bank Nifty. Having said that, I think, also in the sense that this is a sector which is fairly liquid. So if people want to hedge or short, this becomes a great instrument to do that. Sometimes you just have this global correlation, right? Banks go down everywhere. Banks in India also go down. But I think that to me looks like a very temporary phase. The only thing that I would say is that typically the banks were benefiting from a rising rate scenario, right? So they typically benefit because the assets get repriced first and the deposits take time to reprice. And we've seen a superb Goldilocks scenario as far as the NIMs are concerned.
Okay.
And I think if this is something where the market is sensing that maybe one more just last rate hike from the RBI and then a pause, I think you will see that NIMs more or less would have peaked for the banking sector in India.
Hiren, wanted to get your thoughts in on the tech sector. At the beginning of the year, your call was that the Indian IT sector is likely to bottom out in the first half of the year. Given the concerns surrounding the US global banks, the possibility of them being capital constrained and therefore going slow on their tech budgets, maybe cutting back, is there a risk to the earnings of IT companies more than what you had anticipated, say, in the month of January, given what we've seen right now?
So, Rima, I mean, you cannot wish away the fact that there would be some uncertainty around tech spending, especially with the smaller banks, right? The smaller regional banks and so on and so forth. But we need to recognize that maybe the discretionary part of the spending are cut. We do not know as of yet. I don't think even the companies know that. But you know that when something like this happens, the markets typically tend to price in the worst. And then as and when things unfold, either things snap back or, you kind of then the market starts to price in the actual reality, right? But initially, the market typically tends to have a knee-jerk reaction and it prices in the worst. And I think that's what happened in the tech sector, right? But you could also argue that most likely there will be more stricter regulation when it comes to the smaller banks and the regional banks. And when that happens, that could actually mean higher tech spending by these banks, because we have seen in the past, for example, after the global financial crisis, when there was more regulatory and risk management, actually there was a rebound in tech spending at that point in time. So maybe there could be a hiatus for a quarter or two, but it may turn out to be a boon in disguise for the tech sector, in my view.
That's an interesting way to look at things. I think you're referring to Dodd-Frank, right? And I think that benefited financials quite a bit. Hiren, it's a pleasure. Thank you very much for joining us on this program, and look forward to speaking with you soon again. Well, guys, that's it. Finally, for the week. So just to recap plans: cricket, sleep, and party, right?
Coffee.
All right, coffee. You sure it's just coffee, right?
All right, I think we'll say goodbye. Thank you very much. Have a restful weekend, and we will see you back on Monday morning with all the latest action.